in the recording. All right. Recognizing revenues, revenue recognition principle states that we recognize revenue when a product or service is provided to our customer and at an amount expected to be received from the customers, right? And expense recognition or matching principle aims to record the expenses in the same accounting period in which the revenues are received, right? We're trying to match the expenses and expenses with the revenue benefits that they generate, right? Just remember when you're the operations of a company, sometimes the expenses are incurred way in advance of revenue being, right? I'll give you an example. Let's say, for instance, Dominion Power, everybody know what Dominion Power does? What? They what?
Is that electricity?
Yes, electricity, right, they're the power. So let's say we have a gentleman, it's December, you know this guy, he's going all out for Christmas, right? He's got his house lit up like a UFO. You see it off of 7. Your friends call you and say, yo, have you seen that guy's house? He's got like Santa landing on his chimney, like a Delta airplane, you know. And you can see that guy when you fly into Dulles, right? You look out and right. Right. So he runs up a bill and say he runs up $2,000 bill. He's not playing. He's all about Christmas, right? Now, that bill happens on December 31st. Probably the meter gets checked, let's say January 1st, right? And they say, hey, he ran up a $2,000 bill in December, and they'll send the bill, let's say on January 10th. He'll get it on January 15th. And it'll say pay by February. So the expense is sitting in December. Prayerfully, you'll get your revenue by February. That's 2 months later. But also it's 2 different quarters, right? This is fourth quarter, this is first quarter. So what we're trying to do is make sure that this expense and this revenue come a little closer, right? They're incurred in the same period. Now it might not match what is actually going on operationally, but it's good accounting. That makes sense? All right, so let me slides. So that's how you'll get some disparity. And that's just an easy disparity, right? Like, truth be told, the guy, let's say he misses a couple of months. This guy might not pay until May. And you really got a conundrum, right? Your expenses were in, let's say, December of 2021, but you didn't even get the revenue until May. So how do we bring that together? And so what the rest of this class is going to be is techniques, showing you how that happens, right? So here's another example of the difference between cash and accrual, right? So let's say fast forward, a company pays $2,400 for 24 months of insurance policy beginning on December 1st, 2013. Right? If you use a cash basis, this is what it would look like. You just debit the insurance policy, debit the insurance expense, credit the cash in December, and that's it. For a whole 24 months that they're using this insurance, it would just be zeros. It would look like they don't have insurance. Everybody with me? But if we're using accrual basis, what we're going to do is split that policy over 24 months. And now the external user can come and look at this and say, oh, yeah, they've got insurance. I know because they've got $100 insurance expense for this month. Does that make sense?
So that $100 are like the accrual basis?
Yeah,
Alright.
that's cool. To show you that you have an insurance.
And the empty ones are the zero, just cash basis.
No, this one's cash.
Oh, okay. Oh, I see.
That's cash.
Okay.
Right. So what's the framework for adjustments? Adjustments are when we pay cash before expenses are recognized, when we receive cash before expenses are recognized, when we've paid cash before revenue is recognized, when we receive cash before revenue is recognized, when we've paid cash after expenses are recognized, when we receive cash after the expenses are recognized, when we pay cash after a revenue has been recognized, when we receive cash after revenue. And we'll go through that. And those are, so we have prepaid expenses, unearned revenue, deferred expenses, deferred revenue, accrued expenses, accrued revenue. So let's first start with a prepaid expense. A prepaid expense is when an expense has been paid before you received it. For example, when we paid for insurance, you paid for 2 months, 2 years of insurance. So you'll pay in December 1 year for insurance to coverage the next 2 years. When you do this, you'll debit the asset, which is prepaid expense, and credit the cash. And then every month, when you use 1 month of insurance, you'll debit, let me see. So just like I said, you'll debit. And then every month when you use the insurance, you'll debit the insurance expense and credit the prepaid insurance off of the account. Right? And you'll do that. That's the adjustment. You'll do that until the balance of the prepaid insurance is zero. Does that make sense? And that's the adjusting entry. And there's your journal entry. Debit, insurance expense, credit. Questions, let me go back. Questions on that. So that's prepaid insurance. Next, we have supplies. Supplies, I'm going to introduce you to this equation. When we do supplies, there's an equation, beginning inventory plus purchases minus ending equals what was used. So beginning plus purchases minus ending equals what was used. So this thing is following. With that being said, look at this example. Fast Forward purchased $9,720 worth of supplies in December. Some of these were used, some were used in December. So what they're saying here is that they purchased, beginning inventory was zero. They purchased $9,720 worth of supplies. Ending inventory was $8,670. So if you do the math, they use $1,050 worth of supplies. So that you need to debit supplies expense and credit supplies. A lot of people think in accounting, what we do when you call, sometimes they'll call accountants pencil counters or paperclip counters. What they're saying is, oh, they're counting every penny. But that's not really what we do. We'll have the beginning inventory, how much we'll purchase, and then we'll come back and do another inventory to see how much is still there. And then we'll run this count. That's it. And it was like, oh, we used $1,550 worth of supplies. Everybody with me? This is a journal transaction. Debit, supplies, expense, credit supplies. Supplies is what type of account? The asset, liability, capital in, capital out, revenue or expense. Asset, fantastic. All right, depreciation. So I'm just going to show you straight line depreciation today. Depreciation has its own chapter. It's chapter 8. It's long-term assets will do depreciation. They should, in the homework, basically give you the answer prayerfully, right? Like they'll say depreciation is X, and you got to go from there. That makes sense. But in order to find depreciation, you're going to take the assets, cost minus the salvage value divided by useful life. This is just for straight line depreciation. So here's an example. The depreciation, fast forward, buy some equipment for $26,000. Equipment has a salvage value of $8,000, right? And it has a 60-month useful life. So we're thinking $300 a month is going to be the depreciation. This is how they calculate that. Here, they've given it to you. So $12,000 is the depreciation. It's a different question. And then what we'll do is debit depreciation expense, credit accumulated depreciation for $12,000. Accumulated depreciation. Accumulated depreciation is what we call a contra asset account. Why do we call it a contra asset account? It's an account that's in the asset portion of the balance sheet, but it's contra, or you subtract it like that. Does that make sense? You're going to see other contra accounts and adjunct accounts, right? So you'll see a contra revenue account, which will be cost of goods sold. It'll be in the revenue section, but you subtract it. Everybody would. Unearned revenues is cash received in advance for the product, right? So let's say, for instance, I don't like these slides anymore because in the past, I guess Beyonce caught up with it, but it used to talk about Beyonce tickets. Now it just talks about something else. So fast forward, paid their client $60 fee in advance for covering a period of December 27th through February 24th and recorded it. Fast forward earns payment as time passes. So at December 31st, 5 days, they received $250, right, for 5 days of that service. And there's adjusting entry reduces the liability of unearned consulting revenue. So what we'll do on the 26th, because they received the money early, they're going to debit cash and credit unearned consulting revenue. Although it's a revenue account, it's a liability. Why is it a liability? It's a liability because although we receive the cash, we owe that client either their money back or the services we promised. So all the liability is on that company. Does that make sense? Okay. So in a normal transaction, let's say for instance, you go and buy a laptop. You go to Apple, you give them the money, they give you a laptop, they have to instantaneous. But sometimes there's a transaction where you give the money, but you don't get the product instantaneously. You get it 5 or 10 days later, right? Or in this case, this is for consulting that's going to happen over 60 days, but they're going to prepay for the consulting. When it's prepaid, it's not that instant transaction, then all the liability is on the consulting company. Right? It's not on the client. Because the client is paid, and now the consulting company either owes the client money back or those services they promised. So that's why we put it as a liability. So initially it's a debited cash, credit to unearned revenue. And then on December 31st, what we did, we made an adjusting entry. So we debited unearned revenue and we credited our revenue for $250 because now it's earned. Everybody with me? For those 5 days. And we picked December 31st because that's the end of the annual. That makes sense. So we're going to make an adjusting entry for that. And then in February, see, this is the December 31st transaction. Oh, they didn't have it. Well, in February, when we finished the process, we're going to debit on our revenue $2,750. This will happen February 28th, whatever the last day of it. And we'll credit our revenue for $2,750. That makes sense? Because now we've earned all the revenue. Right? And this one is accrued expense. Something simple like wages, right? See these workers say, we're about 1/2 done with this job and want to be paid for our work, right? So when that happens, we'll debit an expense and credit a liability, like wages payable. So in this example, let's say for instance, the last payday ended on December 25th. The next payday is January 1st. The year end is December 31st. What we want to do is capture these 5 days into this year, and then the rest of the pay into the next year. So how we're going to accomplish that is Fast Forward pays its employees $70,000 per day. Fast Forward pays its employees $70 per day for $350 for a 5-day week. Salaries are paid every 2 weeks, 10 days on a Friday. December 31st is a Wednesday, so 3 days salaries owed $210. So the adjusting entry for the $210 is debit the salaries expense, credit the salaries payable. That's to show they owe for those 3 days in that year, right? Then, oh, this is just the T account. Then in the future, let's say on January 9th, when it's time to pay, right? we're going to debit the salaries payable for the 3 days that we set to the side that we owe, right? We'll debit that $210. We'll credit the salaries expense for $490 and we'll pay out cash for $700. That makes sense? So there's 2 transactions going on. This transaction here, so the first transaction is to put salary expense for December, what was that? 31st, 30, 29. December 29th through 31st on the books. That's what we're doing here. We're just trying to say, hey, we're trying to capture the salary for the entire year from January 1st to December 31st. So that transaction is just to capture those last 3 days. Everybody with me? Now, the next 7 days, and when we pay is, I think, the 9th, January 9th. Yeah. So what we're doing here is on January 9th. So think of this as 12/31. Then on January 9th, what we're doing here, we're paying out our employees. But part of it is sitting in a liability. So we need to zero the liability. And then the rest is just your regular transaction, debit, salaries, expense, credit. So 2 weeks from this, let's say it was January 23rd, right, is the next time they get paid. The only thing you would see was a debit to the salaries expense and a credit to cash. Right? The only time you would make this adjustment is at the end of the year to capture like 3 days that happened in 2021 or 5 days or whatever. That makes sense? So that's accrued revenue. Accrued revenue happens when you have finished the work, they owe you the money, but they haven't paid you yet. So fast forward, company agrees to pay $2,700 of the next year of future services over the next 30 days. So December 31st, 20 days worth of service have been completed, but which would have given them $1,800, 20 out of 30 days. So the adjusting entry for that needs to be a debit to accounts receivable for $1,800 and a credit to consulting revenue. So you're saying, hey, we finished the work, they actually owe us the money, and they're accruing it into the year that they've done it. That makes sense? This is the T account. Future receipt. But let's say, for instance, on January 10th, they pay off what they owe. What we would do, we debit the cash. They paid us $2,700. We credit the accounts receivable for $1,800, and we credit revenue for $900. That $900 represents the 10 days, January 1st to January 10th. This $900 represents the 10 days that they owe for that year. So that's what you're saying. All right, so that's the last adjusting entry. So now you're home free. Let me tell you guys something about accounting. The debits or credits are all the hard work. All the hard work is getting the debits and credits. Once you get to what you see on the screen, you are home free. When I was in you guys' shoes, the second time, I will date myself and say the first time I was in you guys' shoes, we used to have to do debits and credits on a ledger, like an actual book. Have to buy a black book, bring it to class, open it up, and write debits and credits. I had a miserable teacher. Right? Anybody want to exchange bad stories about professors? I'll be more than happy to give you a run for your money. Probably never. I mean, I've had some pretty horrible teachers, some great teachers too that I still keep in contact with. Love them to death. But man, you talking about bottom of the my first accounting teacher was having an affair with a friend of mine who I hate. You have a friend, but they're not quite your friend, but they're your friend. Like y'all have been around each other for years, but like, huh?
Like a school friend?
Yeah, like somebody, but you know they're not a good person. Like and the minute he told me that, and I didn't know until the first day of class. I was like, oh my God, like this is horrible, right? And he introduces us and I shake her hand. No, this is the day before class. And the minute she walks away, he says, dumping her tonight. And I'm like this is the type of dude he was a donkey's ass, right? He dumps her that night. She comes in the morning, fresh for class and fresh for lunch. That was probably my worst teaching. No, I've had two others that were pretty bad, but she was top. She was the worst. And but in her class, and she never believed that computers would ever take over in accounting. She did not believe in computers. So all we did our work in was that sucked too, because I was an intern at Exxon, and all we were doing was our computer work, was our work on the computer. And she was like, that'll never happen. They'll never make that. So, so I'm saying when I was you guys' age, we did all of this by hand. Now you're doing it on a computer, which you're welcome in some respects. Right? But when you're doing this, it's the debits and credits that are the hardest. Everyone with me? Once 80% of your work is debits and credits. Once you get to this point, you're home free. So what I used to do is do my work, the debits and credits. And then once I got here, I would set it to the side. And then I'll come back and do it again when I'm watching, like, I don't know, Grey's Anatomy, or like something that takes less thought, right? Maybe not Grey's Anatomy. Grey's Anatomy takes a little bit about wrestling, football. That's what I was watching, right? That type of stuff. I either watch something pretty intellectual or pretty stupid. So I call Grey's Anatomy something. So football or basketball or boxing or something, that's what I do this part of the homework, right? What I'm going to show you. So that's the unadjusted trial balance. I showed you that in chapter 2, right? It's just all of the accounts. The revenue is sitting here at the bottom. The balance sheet is sitting at the top. Pretty simple. Everybody with me? Now that I've shown you adjusting entries, that's going to be the second part of this, right? So you're going to put in adjusting entries. Bing! Adjusting entries. Some of these you should remember, right? Remember, supplies and expense was $1,050. We did have accounts receivable of $1,800. There's the other part of that, supplies. consulting revenue of $250. So some of these you'll remember. Now, what do you do? How do you get this adjusted trial balance? If you have two debits, you're gonna add them. So you have, like here in salaries expense, you have a debit. You had a debit over here for adjustments, so you'll add those. If you have two credits, you'll add them. So in the unadjusted trial balance, you have consulting revenue, you have revenue in the adjustments, so you'll add those. If you have two different accounts, so you see here, you add, right, 1,610, consulting the revenue, you add these. Everybody see that? If you have two different accounts, let's say you have a debit and a credit. Here, prepaid insurance, $2,400. If you have a debit on the unadjusted trial balance and a credit on the adjustments, you'll subtract those, right? And whichever is larger, in this case, the debit is larger, you'll put it in that column. On the other hand, if you have a credit and a debit here on our revenue, you have a credit for $3,000, you have a debit for the adjustment, $250. You'll subtract those also, but since the credit is larger, you put the credit, you put $2,750. Everyone understand? Two debits, you add. Two credits, you add. A debit and a credit, you subtract. Whichever is larger, that's where you put the cost. Then once you get here, right, there's no real thought in this, right? Like this is very simple. You've got your unadjusted trial balance, you got your adjustment. You go, all right, cash, no adjustment, put that here. Accounts receivable, there's an adjustment, put it here. Supplies, up, here's debit, credit, subtract those, put it here. Debit, credit, subtract those, put it here. Debit, nothing here, put that there. Nothing, oh, here's 375, so I put a credit 375. 6,200 here, there's no adjustment, 6,200 here. Nothing here, adjustments 210, put 210 here. That makes sense? There's no real. You probably go watch Grey's Anatomy and do this, right? Right, and not miss a beat. Then after that, you've got your adjusted trial balance. Then you're gonna take your adjusted trial balance and make your financial statement. What's the first financial statement we're gonna create? What is the first financial statement we'll create? Income statement, fantastic. And the income statement is right here. It's right here in front of you. Right? So you're gonna just take those numbers, right? 7,850, 300, 375. Put them right here. 7,850, 300, 375. Questions? Then you're gonna take the net income and make what statement? Not yet. Off the balance sheet, what's next?
The statement of retained earnings.
Fantastic, statement of retained earnings. That's gonna be next. You're gonna take the net income and make the statement of retained earnings. On your midterm, key in on this statement of retained earnings because it's easy points, you get partial credit. All you gotta know, if you just know these three columns, you get half the credit. You get retained earnings plus net income minus dividends gives you any retained earnings. Where do we get the dividends from? Anybody remember? Where you get the dividend from? Where'd you get this $200 dividend? Yep, it's right there in the adjusted trial balance. You see that? $200, right? That's all we did. We just transposed it. Everybody know what transposing is? Taking the same thing, right? And just putting it somewhere else. That's true. That's it. Nothing complicated. Not blowing your mind here. I told you, I'll watch TV and do this at the same time. You won't miss a beat. Then after you do that, you're gonna make the balance sheet. You need the ending retained earnings to put it onto, right, the retained earnings, and then you'll just take the numbers off the adjusted trial balance, transpose them right onto your balance sheet. Questions? No questions?
Well, the 375, just move it like to the other column, the 26,000, like less,
375?
yeah.
Yeah, because that's accumulated depreciation, that's the contra asset. So just like you're doing a side calculation here, taking the equipment minus the contra asset to get what's the book value. Good question. That was perceptive. All right. Last but not least for this chapter. I just want to look at the slides real quick to make sure. This is the last but not least, the main thing for this chapter is closing entries. This is where we're going to talk about executing an accounting procedure. And you might be able to do it, but you might not know what the hell you're doing. Right? There are a lot of accountants that they're fundamentally sound. They can execute depreciation. They can execute amortization. They know how to find bad debt expense. They can do aging. But they don't know what the hell why they're doing, right? They just know that they're doing, right? So you can be fundamentally sound in this process, but not know why you're doing it. Now, I'm gonna explain why you're doing it, but that's not, I'm only explaining it to make it easier for you to actually be able to execute. But it's not one of these things, it's mandatory for you to know why you're doing it. All you gotta know is that you gotta do it. Everybody with me, right? And just be sound in doing it. So there are two types of accounts on a financial. Two types of accounts. Temporary and permanent. Everyone with me? Temporary and permanent. Companies have been around for centuries that are traded on the New York Stock Exchange. For example, Bank of New York Mellon. Does anyone know, since I hate this phenomenon has happened because everybody also wants to run around and act like they're some fanatic of this founding father. But I bet you not one of them knows this. Does anyone know which founding father wrote the charter for the Bank of New York Mellon? Anyone?
Thomas Jefferson.
Nope. Anybody online want to give a hint, give a guess at this one? Founding father. Nobody. Man, y'all killing our time. Y'all can just give me a couple of hints, then maybe I'll just go ahead and give you the answer and we'll move on.
George Washington.
I'm George Washington. Boy, he's got newfound fame. Oh, he's all. I sit and watch people now say, oh, I love him. And I'm like, fuck this dude. Come on. Who's the founding father? Everybody loves him. But if it was 2010, no one would have. They'd be like, oh, yeah, I remember him. Everybody now is like, oh, he's so great. She come through my accounting. He's the one founding father that's not born in America. No one? At least give me one guess. No. Even if you're wrong, it's fine.
Franklin.
No, that's not bad. Alexander Hamilton, folks. Hamilton, the stupid play. And everybody, even this on Disney now, everybody's like, oh, I love Hamilton. I'm like, Alexander Hamilton. He wrote the charter for the Bank of America, right? As a result, there are a lot of transactions on the Bank of New York Mellon's books. Some of them over all these centuries, right? Some of them are transactions you'd be like, ooh, that's great. And some of them would you, as an external investor, wouldn't care about. For example, do you care about how much cash the company has accumulated since 1792 or something? Since the 1700s. Yeah, you do care, right? You want to know how much cash they've accumulated over those years. Do you care about how much land and buildings they've accumulated over that time? Do you care how much they have paid in electricity over that time? No, right? Because remember, in 1800s, electricity was really what? What were they buying? What were they buying to keep lights? Candles, candle wax. Do you care how much candle wax they bought in 1800? Is that going to change the way you're going to invest in them? How about shrimp? They bought a lot of shrimp in 18. You know why they bought shrimp? Shrimp in the 1800s.
You don't care, right?
You don't care, right? But do y'all know why shrimp would be on the financials? The 1800s. Probably a good part of the 1900s. Oh no, these aren't good shrimp. Wouldn't eat these shrimp after I say what I'm saying. Why is there a big sale of shrimp? Shrimp is what was used to clean out the outhouse. Remember, there's no indoor plumbing. So they take shrimp and dump them down, clean the pot. As I said, it's not that shrimp. Don't like the shrimp. Right. So, but they would have a space line for shrimp, right? Like we have for water, right? And sewage, they'd have shrimp. Everybody don't turn your nose up. 100 years from now, it might be a different way that we get rid of our sewage. And people be like, do you know they used to use water and just run water through a house? Oh my God, isn't that horrible? Right? My grandmother was so nasty. Like, you was like, what? But back then they used shrimp. All right. So we've identified that there are things you wouldn't care about and there's things you would care, right? Now, those things that you would care about, basically, we call those permanent accounts. Right? Those are accounts that we always keep on the books. Things that we really don't, the investor, the external investor really wouldn't care about. Those are temporary accounts. Those are accounts that we take off the books, right? So every month or year, we reset the books to zero and just calculate what we owe that year, right? For example, electricity. We only, as an investor, you really only want to see what they're paying this year. You don't want to see what they've been paying since the beginning of the company. So the closing process closes those accounts that we really just want to see what they owe in the current year. And we don't do anything to permanent accounts, right? Now, let me give you a shorthand. And this shorthand is going to help you in doing this process. And the shorthand is pretty simple. And it tells this tells you what are temporary accounts and what are permanent. Let me give it to you. Temporary accounts is everything on the IS, which is what? Everything on the income statement, dividends, and a new account that we're going to create during the closing called the income summary. That's it. Everything on the income statement, dividends, and the income summary. Permanent accounts is everything on the S, which is what? BS is what? Balance sheet. Yeah, it is. I knew that was coming. We do nothing. You don't worry about the permanent accounts. That means every account on the balance sheet, you don't change it. That means the pre-closing balance sheet should equal the post-closing balance sheet. The pre-closing balance sheet should equal the post-closing balance sheet. Everybody with me? Now the income statement post-closing should equal zero. So you might be asking why. Here's how that works. Remember, we have revenue, we have expenses on the balance sheet. On the income statement. Let's say consulting revenue was $2,500 and salaries was $18,100 debit. What we're going to do, we're going to debit we're going to credit the expenses and we're going to debit the revenue off. So we'll debit the revenue off of the revenue account and credit it onto the income summary account. And then we're going to credit the expenses off of the expense accounts and debit those onto the income summary accounts. When we do that, when we put all the expenses on the income summary and all the revenue on the income summary, what happens is the income summary, so two things happen. The first thing you need to see is that salaries become zero, revenue becomes zero. You see that? So that's why I said the income statement post-closing is going to equal zero because we're going to zero out all the revenue, we're going to zero out all the expenses. Now the income summary will equal the sum of the income summary will become net income. And when that happens, now we're going to put the dividends. Oh, we're just moving, sorry. We're going to debit that off of the income summary and credit that onto the retained earnings. And the final thing we're going to do, we're going to take the dividends because I said we're going to do the dividends. We'll credit the dividends off the dividend account and debit it onto retained earnings. I got a question. Look at this. This is beginning retained earnings plus net income minus dividends gives you ending retained earnings. Where have you heard that from? Where have you heard that before? Beginning retained earnings plus net income minus dividends equals ending retained earnings. Where have you heard that before? Huh? No, yeah, that's close, no. I mentioned it in this class and last class. Anyone online knows? I think people online. Jose Escalante. Jose Escalante. Dang, somebody dropped off. Jose, maybe I should just start.
I'm sorry, can you repeat the question?
Where have you heard beginning retained earnings plus net income minus dividends equals ending retained earnings? Brett Oswald. Brett Oswald. Are these people even on here? Escalante, all you did was ask me, could I repeat the question? But you don't have nothing else? You didn't
No,
say
I don't know, sorry.
no? Are you paying attention?
Yes.
Don't have none. Brett Oswald. Brett Oswald. We start kicking people off. My microphone won't connect. You probably won't be the first person to say that, sir. Abby Casa.
Yes, sir.
Where have you heard that from?
Do you mind giving me a moment to look back? Was it earlier in the?
What, you think you wasn't gonna get called on? Nobody thought they were gonna get called on? Don't worry about it. It's the statement of retained earnings. So just make sure that your statement of retained earnings equals that, and you'll be fine. Everybody with me? And then that's it. I think that's it. Oh, this just shows you the flow. The accounting cycle, what we've done. We analyze transactions, find out if they're material and immaterial, journalize them, post them, get an unadjusted trial balance, we adjust them, we prepare adjusted trial balance, make the statements, income statement, statement retained earnings, and balance sheet. We will do this process up to the balance sheet on your midterm. And then statement of cash flows will be on your final closing entry. We don't do reversals, those are beyond the purview. Classified balance sheet, classified balance sheet. I'll let you guys look at this yourself. But it's our balance sheet is in the form of liquidity, where our current assets first, long-term assets second, current liabilities first, long-term liabilities second. That'll be the end of that. All right, so that's chapter 3.